Credit spreads are so tempting. You sell them for credit and collect 20%, 30% or more a month, all while working and doing other things. And if you traded credit spreads even a little bit, you've seen some situations where they can get tricky. So the question is, how do we actually make trading credit spreads consistent and passive so that we can trade them for a living? Today, I'm going to show you the most important concepts that allow me to trade credit spreads for a living. So make sure you guys all like and subscribe, because this is going to change how you trade these spreads. If you want to learn what credit spreads are, make sure you guys check out this video linked in the upper right hand corner. Watch that first, and then come back to this video. But if you know what it is, let's get to it. As credit spread sellers, we want to 1. Maximize credit, and 2. Maximize win rate. And as option sellers, we are told that we want to trade stocks with higher implied volatility to increase those premiums, and 2. Trade longer term DTEs so that theta can decay out the values of those contracts. But what if I told you those are not the 2 most important things to focus on to make this passive and consistent? So today we're going to look at these 2 most important factors that allow us to trade credit spreads passively and consistently. The first concept is something that I like to call predictability. And second, it's more common, it's called volatility. So what is predictability? To me, it means how long can I trade in one direction and how consistent is the price action of that stock or ETF. Even though credit spreads can be sort of non-directional, most spreads are going to be directional to a certain extent. And in most cases, we don't want to be the wrong side of the trade because it creates unnecessary stress. And 2, psychology has proven that it's very hard for humans to realize losses. So whether or not you believe in technical analysis, we can probably all agree that markets go in trends. They either go in an uptrend, they downtrend, or they stay stagnant and channel. If we follow the trend, we'll win much more often, and more importantly, we'll have a higher margin for error. Even when we make mistakes, which we inevitably will, the market might be able to bail us out more often. So this is essentially what predictability means. How often can I assume that the trend holds so that I can trade the trend? So let's demonstrate and explore why predictability is such an important concept to understand. If you were to trade a put spread in the bullish direction, starting from October of 2023 all the way up to March of this year, you would have won every single one of your trades, even if you were to sell right at the money. Like for example, if I sold at 4,100, the next week I sold at 43.45, the following week I sold at 43.87, I would have won every single week for around 6 months straight. And that's essentially what we did for the 24K to 100K video, right? We just followed the trend. However, if you were to sell on the opposite side, let's assume that we were shorting and we sold the call spread every single week for that 6-month period, we would have lost every single trade. Or another example could be, back in 2022, I did a exercise where I only traded call spreads. And why did I do that? It's because the market was in a downtrend at that time. And so when I traded the call spreads, I won basically every week because the market was in a downtrend. And so when we're looking for credit spreads to sell, we have to look for not only volatility, we also have to look for predictability in the stock. So we're going to compare a couple charts really quickly just to understand how we can see predictability. Let's compare Microsoft or Tesla and look at the charts themselves. Which one has the most obvious pattern? Microsoft is obviously in an uptrend. And if you really want to be technical about it, you can see that it has formed an A, which is a low, B, which is a high, C, which is a higher low because the market couldn't push it down further, and D, which is a higher high. The market has so much demand that it pushed the stock to continue to go up. It's an obvious uptrend. And remember S&P 500 back in 2022, it was an obvious downtrend, so that's what we did for the call credit spread challenge, right? Because it was in a downtrend, A to a B, which is a low, C, which is a lower high, right? Can't go any further. And then D, which is a lower low, a lot of selling power. And so this is an obvious downtrend, and we just want to trade call credit spreads during this time. But starting in 2023, uptrend the whole way until recently. But now compare that to Tesla. In 2022, Tesla's very obvious, downtrend. But in 2023 and onwards, it's a lot harder to determine what the trend is. Is it up? Is it down? Sometimes it's up, sometimes it's down. Now it's maybe up, but maybe not. And so being able to choose a direction is a lot harder. Not to say that the Tesla isn't tradable, like a resistance at 270, a support at 150, or support at 200, but it makes things a lot harder as opposed to just trading the trend, which is a lot lower effort and a lot more consistent. And so if you're looking for stocks with consistent patterns, you can trade, for example, Costco is one of them, ASML is another one, AMD, choice, Google, Apple. So this is essentially what we do for the most part for credit spreads, is that we just want to trade the trend. It doesn't matter how far the market goes. We just want to be on the right side of the trade. Now the second part, which is implied volatility. And you might be like, hey, credit spread investing, we know implied volatility is important. In your Credit Spread 101 video, you told us to scan for credit spreads higher than average implied volatility. But what I'm talking about is slightly different. What we know, right, is that when IV spikes or increases, our options will also spike. But more importantly, as option sellers, is when IV drops, your option prices will also drop. So what we care a lot about, beyond just the implied volatility of the stock, we also want to know the changes in implied volatility. So when IV is high, theoretically speaking, right, we want to sell options. And when IV is low is when we want to be careful about selling options and maybe potentially even buy options. So the first thing that we have to do is we have to know what the IV is for a particular stock. If you're on Thinkorswim, what you can do is you can go and chart out what the implied volatility is by looking for the implied volatility indicator and adding that to any one of these. And you'll see that pop up right now. And this is essentially what implied volatility looks like. As stock markets or stocks go up or down, implied volatility will also go up or down depending on price action. So let's go back to what we know. We want to sell when an IV is high, because when IV drops, our options will become worth less. And as credit spread or option seller, we'll end up making money even if the stock remains flat. And so by looking just at the implied volatility chart, how do we know when these peaks will happen? Because we don't want to be selling here, we want to be selling here. But if you were to, for example, go all the way back here, how do I know that this is not going to be the peak and that this isn't going to continue to go up? I can tell you that there's actually a very relatively simple way to do so. So we're going to pull up implied volatility and we're going to look at price action. So let's just look at this one here because it's just easier to understand. So this one correlates to this candlestick right here. And what's special about this candlestick? Right, this is what the low previously was. So that's an area of support. Let's take a look at another one. Let's look at this one right here. Oh, this is potentially an area of support. Why? This is a 200-week moving average. It's an area of support. What about this little peak right here? Area of support, right? This is where it currently was, previously was. And what about this right here? It peaked right here, area of support. And it drops because the market went up. And what happened to this one? Oh, this is a potential area of resistance. And then let's look at another one. This one, boom. What is this? Resistance, right? This is where it would use. This is the resistance where it was before. The market entered this level, and they're like, "Hey, it might sell off." And so you can see there's a correlation between area supports and resistances and increased implied volatility. We can do the same exercise on S&P 500. You can do the same exercise on any other stock that you want to. You can see these peaks usually happen in areas of supports and resistances. Now let's correlate that to the definition of implied volatility. IV is the market's expectation or prediction of how much something will move. And so when it enters an area of supply and or demand, otherwise known as support and resistances, doesn't matter what the terminology is, the market's probably expecting and is expecting a larger than expected move when it enters those areas, because that's where people will end up buying and selling. And more often than not, that's going to be where your volume is going to come in as well, right? There's a lot more volatility in those areas because there's a lot more people looking to trade those areas. If we know that from looking at the charts, then we want to be selling credit spreads in these areas of supply and demand. Because why? Because if and when IV gets crushed, the option prices will also drop. And so we have a much higher chance of winning for a lot less risk. And I'm going to use an example to demonstrate this principle. So you can see right here, on this day on 7:30, volatility spiked and it subsequently dropped. And the reason you want to look at this one is because if you zoom in here, volatility dropped while stock price actually ended up lower. So what we're going to do is we'll go to on demand on Thinkorswim and we're going to look at the historical pricing for a credit spread on July 30th and July 31st. So we'll go to July 30th here, and we're going to look at it at 10 a.m. And I'll show you why. And we're going to drop it down to 30 minutes. This implied volatility chart will work on any time frame. And just to reiterate, right, it enters a level of support, it spikes, enters a level of support, it spikes, enters a level of support, which we're in, it will spike. So let's assume that at 10 a.m., this is where it re-entered this level of support. It hit the 417 low of the previous couple of days, and you're like, hey, I want to trade this area of support because I like the price action. And on top of that, volatility has peaked again at the same level as it was before. I think this might be a good trade. So we'll go to trade. And just for simplicity's sake, we're going to look for something a little bit closer. So let's just do the August 16th. And we're going to choose something relatively aggressive, right? We're at 418. Let's just do 410 for demonstration purposes. For this one, you'll collect around $190 for around 2.5 weeks. Remember, implied volatility is really high. It's at 38.34%. In around 2 weeks, you can get around 70% ROI on this credit spread. Microsoft only has to drop 8 points and see what happens. So we're going to move forward 1 day to July 31st, and we're going to take a look at the chart. So remember, at 10 a.m., it's at the low of the day again. It's around 414.55 cents. So Microsoft actually lost 4 points in value. But what you will see is this day right here, implied volatility plummeted from 33 all the way down to 25. So we lost 3 points, but look at our option pricing. We actually end up making money. We're up $20 on this trade, even though Microsoft fell by 4 points because implied volatility went from almost 40 to 25%. So let's do the same example. Let's just go up one spread to 405, 400, just for another example. We're still really aggressive, right? We're at $162 a spread. Let's move it forward 1 day and see what happens. It's at 132 now. So we dropped another $30, even though Microsoft fell by 4 points. This is the power of implied volatility. Even if you sell relatively aggressive, you will end up making money, even if it's on the wrong side. So we're going to do one more example and just show you how powerful it is when the stock goes with you in the right direction, as well as implied volatility getting crushed. So we're going to jump back to the charts and we're going to go back to the daily view. So let's assume that you had the wherewithal on this day right here, which is August 5th, to want to sell a credit spread. Because why? It's entered this area of support again, right? Which you saw on April 25th, 1, 2, and now it's re-entered this area. And so on August 5th, you're like, hey, I want to maybe potentially enter a trade. So we're going to August 5th, which is a Monday. And we're going to look, and we'll jump to later in the afternoon so we can take a look at the price action. And we're going to drop it down to the 30 minutes. Let's assume here, 11:30. So we'll drop back to 11:30 that we were able to pick up that spike on volatility right here. So volatility is at 38%. We're at 394.66. So let's assume here on this day that we're going to trade. We'll do the 18-day out one. Let's just actually sell this in the money, just to demonstrate, right? We'll go to 395 here. So you're making around $250 on this trade, which is pretty good, as you would expect for being in the money. Let's jump forward 1 day, because we know the next day the market actually went up. So we'll go to the 6th at 11:30. We'll jump over to the chart just to double check. You can see implied volatility gets crushed. We're at 0.29. It was at 394 before. Now we're at 404. And take a look at the pricing. We're at 162 now. I went from 250 to 162. You can see by having this stock move in the right direction alongside with implied volatility getting crushed, you made almost $100 per spread on this 1 day. That is the beauty of being able to sell aggressively and having IV get crushed so that you don't actually end up losing much money if it goes the other way. But you end up making a lot of money if it goes in the right way. And so that's basically it. So just to summarize, since you guys have stayed till the end, the secret sauce of selling credit spreads passively and consistently is when you want to trade the trend, or you want to be on the right side of the trade. Because then you can take advantage of number 2, which is a drop or a crush of implied volatility. By selling credit spreads relatively aggressively, by collecting a lot of premium in areas of supports and resistances. You guys can identify 1, the trend, and 2, identify areas of high implied volatility. You'll be able to transform the way you sell credit spreads beyond just looking at delta and or other metrics. If you guys learned something, Please do consider liking, subscribing, commenting, and sharing this video. It will really help me out. And two, if you want to see this concept in action, make sure you guys check out this video linked in the end screen right here, where I made 60% a month by selling both a put credit spread and a call credit spread on the same stock. Until next time, this is Credit Spread Investing. Stay safe in the market. Peace.